Hello, Eleanor Beaton here, and welcome to another episode of the Woman Owned podcast. Last week, I ran an episode called Seven-Figure Authority Mid-Market Position, and we were exploring the fact that many women operators have seven-figure authority, but they are operating below their natural cruising altitude. This week, we are building on that topic and really taking a look at what this positioning misalignment does to the economics of a business. So when you are carrying seven-figure authority, but you are operating with six-figure economic misalignment, we would call that six-figure monetization. If you are looking to position up, earn more, and solve more expensive problems and be more richly rewarded for doing so, this episode is for you. I was recently speaking to an operator who is a former senior executive and highly credentialed. Over the course of her career, she's probably deployed close to $500 million in capital. And she, through her entire professional career, has solved problems that are worth anywhere from $100 to $500 million in revenue or enterprise value to the organizations that she served. And when she went out on her own and launched her consultancy, she went from solving problems for high altitude organizations that were worth, and by the problems, I mean, these organizations were worth billions, but the problems that she solved for them were worth $500 million, hundreds of millions of dollars. She went from cruising at that altitude to solving problems for individuals that were worth $50,000, $100,000, $250,000. And because of that, because she was solving smaller problems, that was reflecting in what she's able to charge, the nature of the engagements she's actually able to do, and it was actually suppressing the overall revenue that she's able to create, the profit that she's able to enjoy, and the sort of overall margin in her life, like her ability to have open time because she's so busy on a treadmill selling lower ticket deals to lower value buyers. This is what it means to have seven-figure authority and six-figure monetization architecture. Positioning creates monetization. So a lot of founders think that when we talk about monetization, and monetization is really how the business makes money. And most founders think about monetization when they think of it at all, either as their offers and or their pricing, right? So they think that the way to handle monetization, or all that monetization actually is either what you sell, i.e. your offer, or your pricing. Now, they are partly correct. And if you think that, you are partly correct, because early in the establishment of a business, that kind of is what it is. You have to figure out, what am I going to sell and how much am I going to charge? And when back in the day, when I first started doing this work, and I was also working with much earlier stage businesses, that's what we looked at. We looked at their offers, we looked at how much they were charging, and that was sort of the extent of how we examined monetization architecture. And if you are listening to this episode and you are more in a startup mode, that is absolutely where you should be. The problem becomes, as the business starts to get traction, and as you get out of that initial survival mode, you need to become much more sophisticated about monetization, or you're going to get trapped under earning because you haven't positioned yourself properly. It's not that you're not charging enough or you're underpricing. That is way too simplistic. It's that your business is actually not positioned where it needs to be, and the downstream effect is to suppress your overall monetization architecture. I'm going to dive more specifically into what I mean by that. So when we think about monetization architecture, it always starts with your positioning. Who are you for? So once you identify who you are for, it is your buyers who determine your offers. And then your offerings determine the pricing. And here's what I mean by that. Let's go back to the operator I was talking about at the top of this episode. So if she is solving a problem that is worth $100,000 to an individual over a 5-year period, right? So let's say over a 5-year period, the thing that she offers is going to make the difference of about $100,000 in value to that individual over 5 years. That's $20,000 a year in value that's created. If she can't charge $20,000 for that offer. Why? Because there's no ROI, right? There's no ROI for the buyer. So when you're pricing, you need to create asymmetry. So the problem that you're solving has to be valuable enough that there is a significant upside and return on the price you charged. So by nature of positioning herself in a market for low value buyers, that has impacted the types of offers that she can give and how she prices them. From there, your pricing also determines your overall revenue architecture. So if you are selling a deal and it's worth $3,000 to your business over the course of a year versus selling a deal that's worth $300,000 to the business over the year, that has two very different types of revenue architecture. One is going to be very, very heavy on marketing, and the other is probably going to be heavier in terms of delivery. And then one thing I will say is that the market actively pulls downward unless you actively resist it. And this may be one of the most important things you hear this year. I'll give you an example. And this example, I'm talking about a very specific instance, but the reality is this could easily be a composite. So in my world, we have this expression called sawdust. And it's this idea that often as you are doing your work of building visibility and marketing and creating a strong customer acquisition system to get in front of, say, premium buyers, you are generating a lot of awareness. So you probably noticed this as you sort of maybe you speak or you run ads or you have a podcast or you have embedded partnerships or you're actively involved in networking, whatever it is. Through those marketing efforts, you attract your ideal buyer, but you also attract lots of people who aren't your ideal buyer. Maybe they're earlier stage. Maybe they would love to buy from you, but they don't have the budget to buy your full thing, so they'll buy a cheaper version. And so I have seen this over and over. When a company sees this, because operators are smart and they see, oh, wow, look at all of these other people we're attracting. Why don't we sell something for them? So this is called using the sawdust. And what invariably happens is that the business starts to anchor around the lower ticket offer and the lower level buyer. So there's a very strong gravitational pull that if you have 7-figure authority and premium positioning, you must actively resist this. It will feel very logical to do, and it always drags your market down. And the term from economics, bad money chases out good, that lower altitude buyers and smaller offers will almost always cannibalize your higher ticket offers because higher ticket buyers generally are quite cagey. If they sense that you are not for them, they will take their money elsewhere. So I guess what I wanted to kind of establish there is that your positioning creates monetization. Your positioning creates who your buyer is, the value, and who your buyer is determines the value of the problem that you're solving. That determines the type of thing you can offer for them. The positioning determines the price point that you can offer. It also determines your overall revenue architecture. So positioning creates monetization. And monetization, again, is how the business makes money. And it's everything from how you sell, what you sell, how you charge, how you retain, etc. There are massive economic consequences, and I've just sort of walked you through one, of having 7-figure authority, but 6-figure monetization. So the first big consequence is one that I just talked to you about, how often, in order to be quote unquote efficient, or you see this rich resource of people that your marketing is attracting into your ecosystem, and you immediately want to sell to them. Another place that I see this all the time is in businesses who sell enterprise level solutions. So they sell to big corporates, Fortune 50 type of companies. And then they'll say, oh, I would love individuals to be able to buy this as well. And so then they take an entire quarter and deploy a sales mechanism so that individual people can buy one-offs of their thing. And had they spent that quarter going after another enterprise deal, you're talking about the difference literally between a maybe $300 sale and a $300,000 multi-year engagement, right? So bad money crowds out good. And that is the economic consequence of having seven-figure authority and six-figure positioning. Positioning has a gravitational pull. It's going to want to pull you down. If you want premium seven-figure authority and positioning, there is a level of vigilance about defending that. And I did talk about that in last week's episode. But what I really want to talk about is the economic consequences and show how when you have seven-figure authority but are tolerating six-figure positioning or six-figure monetization architecture, it suppresses your overall earning power, it suppresses your overall enterprise value, and it becomes a trap that is very, very difficult to get out of. So let's kind of walk through the math. When you have lower value buyers, they tend to have lower value problems, so smaller problems. And it's kind of like the operator is telling you about off the very top of the episode. Seven-figure authority per natural altitude is to solve problems that are worth tens of millions to hundreds of millions of dollars per year to complex organizations. She starts her business and gravitational pull, she immediately drops her positioning to start solving problems that are worth $25,000 to $100,000 for individuals. So these are smaller problems. By the way, does this mean these problems are less worthy or that, the lower value buyers are bad buyers? No, this is not an ethical judgment. All humans are inherently valuable and worthy. I feel like I do need to point that out. But to a business and to the economics of a business, they are not inherently equal value. So lower value buyers have smaller problems. Smaller problems means smaller deal sizes. Who do we call crooks? We call crooks people who charge a lot of money to solve small problems, right? There has to be, that is not power pricing. Power pricing is when you're creating asymmetry and the payoff of your solution is multiple times more than what they paid for it. That is ethical high value pricing, right? You have to have that asymmetry. If you don't have that asymmetry, you're going to get yourself into a situation where you can solve more expensive problems. So small problems means smaller deal sizes. And people aren't dumb. They're not going to spend a lot of money for a low value problem. Smaller problems leads to smaller deal sizes. Smaller deal sizes means you need more customers. Enter the trap, enter the treadmill. If you're on a treadmill, having to constantly be selling more and more solutions to new customers, that can be a trap for seven-figure authority positioning. Now, I was having a conversation with a colleague recently, and she was like, it's not that hard to make $1 million in a business. And it was interesting because we were talking about the fact that the vast majority of people that she knows that have done that are internet marketers. And in internet marketing, when you are selling certain things around internet marketing, or you are very strong as a marketer, that's your primary skill set, you can actually drive a high volume game, right? So that is absolutely a thing. What I see inside our ecosystem, the vast majority of operators we see inside our ecosystem are generally selling complex offerings to enterprise level buyers. And at that phase, They can generally sell a ton more that they're selling. But when you're selling to a sophisticated enterprise buyer, often there's tailoring that's required, there is complexity that's required. So the thing that caps the sale value or the thing that caps the revenue is often the operator's ability to be able to deliver that at altitude and consistency. And guess what that requires? It requires a highly paid team. So you can see, again, this is positioning. So anyway, when you need more customers, then you need a much heavier sales and marketing function to supply those customers. You're officially on the treadmill. Once you have heavier operational costs, now your margins get suppressed. Once your margins are suppressed, you have less cash accumulation. This is the chain. And this is why there are so many operators out there with 7-figure authority and 6-figure monetization. And this comes from that positioning gap. And it's why this problem typically doesn't emerge initially. It usually emerges a couple of years into your business where you're sort of over that part of being really excited, or you're multiple years into the business and your growth isn't compounding the way that you want it to. So I want to look at a reframe here. I think the question when it comes to monetization, if you were listening to last week's episode about positioning and you can see that economic gap and you want to close it, it's not about asking yourself, how do I charge more? I think the real question is, does my overall monetization actually match my authority? The goal, ironically, isn't higher prices. The goal is economic alignment. So there is an alignment between your overall positioning and your monetization architecture, that they make sense, that it is rational, that they are aligned, that they are congruent. This concept of having that congruence, that your authority is connected to who you serve, it's connected to the size of the problems that you solve for your customers, how your offers are designed, how you charge and what your prices are, how you sell. The line that connects those is it must be congruent, and that congruency and congruence is determined through your positioning. So as you can see, some of these questions, and again, in startup, if you're starting up in your business, what I'm sharing with you today is probably academically interesting, but you really do need, the focus really is some good offers, some decent pricing. Let's get some traction under your belt. For many of you who are further into your business, you're noticing that maybe you're working too hard for the revenue that you're creating. Your income isn't compounding into wealth. The cash reserves aren't where they should be. You're on the sales and marketing treadmill. These are all signs that your monetization is below where your authority and positioning actually should be. So again, if you found value in this, if this is speaking to you, if this is something that you would like to work on, definitely reach out. And the best way, honestly, is just to connect with me directly on Instagram or LinkedIn. And I really hope you enjoyed this episode. Can't wait to see you back here, same bat time, same bat place, for another episode of the Woman Owned Podcast. Thank you so much for tuning into the episode. If you found value in what I shared, please go ahead and like this video, give it a thumbs up, and leave me a review or leave a comment below. And don't forget to subscribe. Thanks so much for being here. We'll see you next week.